If you have ever wondered why some investors grow incredibly wealthy over decades, while others lose money, feel confused, or simply give up on the idea of building lasting wealth through investing, then what you are about to hear will completely change the way you think about money, business, and financial freedom. This is not about guessing which stock will go up next week. This is not about following news headlines or listening to analysts on television. This is not about trading, timing the market, or chasing the latest trend. What you are about to explore is something far more powerful, far more reliable, and far more proven than any of those short-term approaches. This is about understanding how one man, Warren Buffett, turned a modest amount of money into one of the greatest fortunes in human history, not through luck, not through insider information, not through complicated financial tricks, but through a clear, logical, and repeatable way of thinking about businesses and their value. Mary Buffett, who was once married into the Buffett family and spent years observing Warren Buffett up close, along with her co-author David Clark, spent enormous effort studying his methods, his decisions, and his way of thinking, and they put it all together in a practical guide that any serious investor can learn from and apply. The principles you're about to hear are timeless. They worked during the great booms of the past century. They worked during the crashes. They worked during wars, recessions, inflation, and technological revolutions. They work because they are rooted not in market psychology or short-term sentiment, but in the fundamental reality of how great businesses create wealth over long periods of time. So if you are ready to stop guessing and start understanding, if you are ready to think like one of the greatest investors who ever lived, then settle in, because what follows may very well be the most important financial education you have ever received. The world of investing can feel overwhelming at first. There are thousands of stocks, hundreds of financial ratios, dozens of investment strategies, and an endless stream of opinions from experts who often contradict each other. Most people respond to this confusion in one of two ways. Either they hand their money to someone else and hope for the best, or they dive into the chaos, buying and selling based on tips, gut feelings, and short-term predictions, only to find themselves no better off than when they started. But there is a third way. There is the way of Warren Buffett. And once you understand it, truly understand it, not just the surface rules, but the deep logic beneath them, you will never look at a business or a stock the same way again. Let us begin at the very beginning. Warren Buffett was born in 1930 in Omaha, Nebraska. From a very young age, he was obsessed with numbers, with business, and with the idea of making money work. He delivered newspapers, sold chewing gum, and ran small businesses even as a child. But his real education began when he encountered the ideas of Benjamin Graham, a legendary investor and professor who is often called the father of value investing. Graham taught that a stock was not just a piece of paper that went up and down in price. A stock was a share of ownership in a real business, and the price of that stock was not always the same as the value of that business. Sometimes, the market priced a business far below what it was truly worth, and in those moments, there was an opportunity to buy something valuable at a discount. Buffett absorbed these ideas deeply. He studied under Graham at Columbia Business School and eventually worked for him. But over time, Buffett began to evolve beyond his teacher. Graham was focused primarily on buying cheap businesses whose stock prices were so low that even a mediocre company seemed like a bargain. But Buffett began to realize something more important. He began to understand that the quality of the business mattered more than just the price. A cheap price on a mediocre business was not nearly as powerful as a fair price on a truly exceptional business. And the difference between an exceptional business and a mediocre one came down to one thing above all else. That one thing is what Mary Buffett and David Clark call the durable competitive advantage. The durable competitive advantage is the single most important concept in this entire approach to investing. It is the foundation upon which everything else is built. So what exactly is a durable competitive advantage? Think about it this way. In any industry, there are businesses that compete against each other for customers. Most of these businesses are in a constant battle. They fight on price, on quality, on advertising, on distribution, and on a dozen other fronts. And because they are always fighting, they can never really relax. They have to spend constantly just to stay in the same place. They have to lower their prices when a competitor lowers theirs. They have to invest in new machinery, new technology, new products, just to avoid falling behind. These kinds of businesses live in what Warren Buffett famously described as a commodity world. They are selling something that customers can get from many different places, something where price is the main deciding factor. And in a commodity world, profits are always under pressure. No matter how well run the business is, no matter how smart the management team, the fundamental economics of a commodity business make it very hard to consistently earn great returns. Now, contrast that with a business that has a durable competitive advantage. A business with a durable competitive advantage has something that protects it from competition. It has a moat around it. In Buffett's famous language, like the water-filled moat that protects a castle from attack. This moat can take different forms. It might be a brand name so powerful that customers will pay a higher price just to have that name on what they buy. It might be a product that people become emotionally attached to and never want to switch away from. It might be a service that becomes so deeply embedded in how a company or individual operates that switching to a competitor would be enormously costly and inconvenient. It might be a patent, a license, or a regulatory approval that competitors simply cannot replicate. Whatever form it takes, the key is that it lasts. It is durable. It persists over years and even decades. And as long as it persists, the business earns returns that its competitors cannot match. Mary Buffett and David Clark spend a great deal of time helping you understand how to identify these businesses, how to recognize the signs of a durable competitive advantage when you see one, and just as importantly, how to recognize when a business does not have one. Because the ability to tell these two types of businesses apart is the core skill of the Buffett investor. Let us talk about what these businesses actually look like. Warren Buffett, over his long career, has identified three main categories of businesses that tend to have durable competitive advantages. The first category is businesses that make products that wear out quickly or are used up, and that have a strong brand name. Think about everyday consumer products that people buy over and over again. Think about the kind of products that have been part of daily life for decades, where the brand name itself carries such power that customers reach for that specific product automatically, without thinking, without comparing prices, without researching alternatives. These businesses benefit from something economists call habitual purchase behavior. Customers do not decide which product to buy every time they go to the store. They already know what they want. They have been buying the same thing for years. And that habit, combined with a powerful brand, creates enormous pricing power for the business. When a business has strong pricing power, it can raise its prices a little bit each year without losing many customers. And when you can raise prices consistently over long periods of time, the effect on your profitability over decades is extraordinary. This is one of the reasons Buffett has been so drawn to consumer brand businesses throughout his career. The second category is businesses that provide a service that people and other businesses need repeatedly, and where the switching costs are high. Think about a financial data provider that every major bank or investment firm uses to run its operations. Once a company has built its entire workflow around a particular service, once all its employees are trained on it, once all its systems are connected to it, the cost of switching to a competitor is enormous. Not just in money, but in time, disruption, risk, and frustration. So customers stay. They keep paying. Year after year. Even if a competitor offers a slightly lower price, the hassle of switching is just not worth it. And that stickiness, that reluctance to switch, is a moat as powerful as any brand name. The third category is businesses that provide a service or a product in a local or regional market where there is simply not enough room for competition. Think about the only newspaper in a small town. If local businesses want to advertise to that town, they have very few other options. That newspaper has a local monopoly. Or think about a bridge that is the only way to cross a river in a given area. The operator of that bridge can charge a toll, and there is no competitor to undercut them. These are what Buffett and Clark call consumer monopolies, a term they use broadly to describe businesses that dominate their markets in a way that gives them extraordinary pricing power. Now, an important thing to understand is that these businesses do not have to be literal legal monopolies. They just have to be so dominant in their space that competition is minimal, that customers have very few real alternatives, or that switching away from them is sufficiently painful that most customers simply do not bother. The presence of this kind of dominance shows up in the financial statements of the business. And this brings us to one of the most practical and powerful parts of what Mary Buffett and David Clark teach. They show you exactly where to look in a company's financial statements to find the evidence of a durable competitive advantage. Because while it is nice to think conceptually about moats and dominance, what you really need as an investor is a way to identify these businesses with numbers, with facts, with things you can actually measure. Let us talk about earnings per share. Earnings per share is the amount of profit a company earns divided by the number of shares outstanding. It tells you how much money the company is making on behalf of each share you own. Now, for any business, you want to see earnings per share that are growing. But for a business with a durable competitive advantage, the pattern of that growth is distinctive. It tends to be consistent. It tends to move upward over time. It does not jump wildly from year to year. It does not disappear entirely in a tough economic period. Of course, even great businesses have difficult years sometimes. Economic downturns affect everyone. But if you look at the 10-year earnings per share history of a truly great business, you will generally see a clear upward trend. The earnings in year 10 will be substantially higher than the earnings in year 1, and the growth will have been relatively steady throughout. This consistency is itself evidence of the durable competitive advantage. It tells you that the business is not dependent on a particular economic cycle, or a particular trend, or the skill of one specific manager. It tells you that the fundamental economics of the business are sound, that the competitive position is strong, and that the earnings machine keeps working year after year. By contrast, a commodity business will often show earnings that swing wildly. Great profits when demand is high and competition is limited. Terrible losses when demand falls or a competitor enters the market. And because you cannot predict when the good times and the bad times will come, it is almost impossible to build a reliable long-term investment strategy around these kinds of businesses. So the first thing to look at when evaluating any company is its 10-year earnings per share history. Is it growing? Is it consistent? Does it show a clear upward trend over the decade? If the answer to all three questions is yes, you have passed the first important test. But you need more than just that. Let us talk about return on equity. Return on equity is one of Warren Buffett's most important financial metrics. It tells you how much profit the company earns relative to the amount of money that shareholders have invested in the business. Now, the way to think about this is simple. If you run a business, you put in a certain amount of capital. You buy equipment, hire people, build inventory, develop products. All of that costs money. Return on equity tells you how effectively the business is using that capital to generate profit. A business with a high return on equity is using its capital very efficiently. It is getting a lot of profit out of every unit of capital invested. A business with a low return on equity is using its capital inefficiently. it is getting relatively little profit from all the money that has been put into it. Now, Warren Buffett looks for businesses that consistently earn high returns on equity. He wants to see returns on equity that are not just high in one good year, but that are consistently high across many years. And when you find a business that consistently earns high returns on equity, that is very strong evidence that the business has a durable competitive advantage. Because here is the logic. In a normal, competitive industry, whenever a business starts earning unusually high profits, competitors notice. They rush in. They try to capture some of those profits for themselves. And as more and more competitors enter the market, the profits of the original business get driven down. This is the basic law of competition. High profits attract competition, which drives down profits until they reach a level that is just good enough to keep existing players in the market, but not exciting enough to attract many new ones. But in a business with a durable competitive advantage, this law of competition does not operate fully. Competitors cannot easily enter. The moat around the business prevents them from stealing its customers, its pricing power, or its market position. And so the business keeps earning those high returns on equity year after year, decade after decade. This is why consistently high returns on equity are such a powerful signal. They tell you that the competitive moat is real, that it is working, and that it has been working for a long time. Mary Buffett and David Clark suggest looking for businesses with returns on equity that are substantially higher than what you would expect in a typical competitive industry. They are not giving you a rigid cutoff number, but the general principle is clear. The higher the consistent return on equity over many years, the stronger the evidence of a durable competitive advantage. Now let us talk about something that is perhaps the most elegant and powerful concept in the entire Buffett approach. It is the concept of retained earnings. Every year, a company earns a profit, and it has to decide what to do with that profit. It can pay some of it out to shareholders as dividends. It can use some to buy back its own stock. Or it can keep some within the business, reinvesting it in operations, in growth, in new products, or in new market opportunities. The portion of profits that the company keeps and reinvests is called retained earnings. And in a business with a durable competitive advantage, retained earnings are extraordinarily valuable. Here is why. When a business with a durable competitive advantage retains its earnings and reinvests them, it earns on those retained earnings at its high, consistent return on equity rate. So if the business consistently earns a high return on equity, every unit of earnings that it retains and reinvests will generate more earnings in the future. And those future earnings will in turn be retained and reinvested, generating still more earnings. And on it goes, compounding year after year. This is the power of compounding applied to a great business. And it is the engine that drives the wealth-building ability of Buffett-style investing. Think about it this way. Suppose a business earns a certain amount of profit in a given year. It decides to keep most of that profit rather than paying it out. Next year, it is working with a larger capital base because the retained earnings have been added to it. And because it consistently earns a high return on equity, that larger capital base generates a larger profit. Some of that larger profit is also retained. Now, the capital base is even larger, and the year after that, even larger still. This compounding of retained earnings at a high rate of return is the core engine of long-term wealth creation in the Buffett model. It is why Buffett tends to prefer businesses that retain a substantial portion of their earnings rather than paying them all out as dividends. Because when a great business retains its earnings and reinvests them at high rates of return, it is creating wealth for its shareholders far more powerfully than if it simply paid those earnings out as dividends for shareholders to reinvest on their own at average rates of return. This is a deeply important insight that is often overlooked by investors who focus too narrowly on dividends. Of course, not every great business should retain all its earnings. If a business cannot find good uses for its retained earnings within its own operations, it should absolutely return them to shareholders through dividends or buybacks. But if a business with a durable competitive advantage can consistently reinvest its retained earnings at high rates of return, retaining those earnings is a gift to long-term shareholders. And it is something Buffett has taken full advantage of throughout his career. Now, let us talk about debt. One of the things that Mary Buffett and David Clark emphasize is that Warren Buffett is very cautious about businesses that carry a lot of debt. And this preference tells you something important about the nature of the businesses he is looking for. Think about it this way. If a business has a durable competitive advantage, if it consistently earns high returns on equity, if its earnings grow steadily year after year, then it generates a lot of cash. It generates more cash than it needs to maintain and grow its operations. And because it generates so much cash, it does not need to borrow. It can fund its growth from internal profits. So when you see a business that is drowning in debt, that is constantly borrowing to fund its operations or its growth, that is an immediate red flag. It may indicate that the fundamental economics of the business are not as strong as they appear. A business that needs to borrow heavily just to stay competitive is not generating enough internal cash flow to fund itself. And that is often because it lacks the pricing power and the competitive advantage that would allow it to generate abundant profits. By contrast, when you see a business with little or no long-term debt, a business that can pay off any debt it carries from just a few years of earnings, that is a very positive sign.
It tells you that the business is generating plenty of cash on its own, that it is not dependent on lenders to survive, and that even in difficult economic times, it is likely to be able to continue operating without serious financial stress. There is also another dimension to debt that is worth understanding. Businesses with heavy debt loads are much more vulnerable in economic downturns. When the economy slows and revenues fall, a business with a lot of debt still has to make its interest payments. Those payments are fixed. They do not go down just because business is slow. And if the business cannot make those payments, it may face bankruptcy, even if the underlying business would eventually recover. A business with little or no debt does not face this problem. In a downturn, it can cut costs, wait out the storm, and emerge intact on the other side. This financial resilience is itself a competitive advantage. It means the business can survive downturns that destroy weaker competitors, and it can even go on the offensive during tough times, acquiring weaker competitors at attractive prices. So, when evaluating any business, pay close attention to its debt levels. How much long-term debt does it carry? How many years of earnings would it take to pay off all that debt? If the answer is more than a few years, that is a warning sign. If the answer is 1 year or less, or if the company has almost no long-term debt, that is a very positive indicator. Now let us talk about how to think about the price you pay. This is where a lot of investors make mistakes. They find a great business, a business with a durable competitive advantage, strong earnings growth, high returns on equity, and low debt, and then they pay far too much for it. Even the best business in the world is a bad investment if you pay too high a price. Warren Buffett understood this deeply. He has often said that the price you pay determines your rate of return. And the method that Mary Buffett and David Clark outlined for evaluating price is elegant in its simplicity. It is based on what they call the initial rate of return. Here is how to think about it. When you buy a share of a business, you are essentially buying a stream of future earnings. The business is going to earn money every year going forward, and as the owner of a share, you are entitled to your portion of those earnings. Now, the initial rate of return is simply the earnings per share of the business divided by the price you pay per share. In other words, it is the inverse of the price-to-earnings ratio that most investors are familiar with. If a business earns a certain amount per share and you pay a certain price, your initial rate of return is the earnings divided by the price. This initial rate of return is important for two reasons. First, it tells you what you are getting for your money right now. If you pay a high price relative to earnings, your initial rate of return is low. If you pay a lower price relative to earnings, your initial rate of return is higher. Second, and this is the really powerful part, in a business with a durable competitive advantage, that initial rate of return tends to grow over time. Because the business keeps growing its earnings year after year, so the earnings per share that you are getting keep increasing. Even though you paid a fixed price for your shares, the earnings flowing to you keep rising. And this means your effective rate of return on your original investment keeps going up. This is the equity bond concept, and it is one of the most illuminating ideas in the entire book. Let us explore it in detail. Most investors understand bonds. A bond is a fixed income investment. You pay a certain price, and the bond pays you a fixed amount of interest every year. The interest does not grow. It stays the same for the life of the bond. But an investment in a great business is like a bond where the interest payment grows every year. You pay a certain price today. The business earns a certain amount per share, which represents your initial income. But then, as the business grows its earnings each year, your effective income from that investment grows too. And because the price of your investment is fixed at what you paid, while the earnings flowing to you keep growing, your effective rate of return on your original investment compounds upward year after year. This is why a great business held for a very long time at a fair price dramatically outperforms a mediocre business held for the same period, even if the mediocre business was initially cheaper. The great business keeps growing its earnings year after year, compounding the value it creates for you. The mediocre business earns a relatively modest return that does not grow nearly as fast. And over 20 or 30 years, the difference in outcomes is extraordinary. Let us now think about the other side of this equation. What happens to the price of the stock when you own a great business? Over long periods of time, stock prices tend to follow earnings. If a business consistently grows its earnings per share at a certain rate year after year, the price of its stock tends to grow at roughly the same rate over the long term. There will be short-term fluctuations, of course. In any given year, the stock price might rise more or less than earnings growth. Market sentiment, economic news, and investor psychology all play a role in short-term price movements. But over 10, 20, or 30 years, the price of a great business tends to track its earnings growth. And so, if you buy a great business at a fair price and hold it for many years, you can expect to roughly earn a rate of return on your investment that is similar to the growth rate of the business's earnings per share, plus whatever dividends the business pays along the way. This is the long-term logic of Buffett-style investing. Find great businesses, pay fair prices for them, hold them for very long periods of time, and let the compounding do its work. But of course, life is not always that simple. You cannot always buy great businesses at fair prices. Sometimes great businesses are priced at high premiums. Sometimes the market is so enthusiastic about a particular sector or company that even wonderful businesses become overvalued. And in those moments, the Buffett investor waits. Patience is not just a virtue in this approach to investing. It is an active, strategic tool. Buffett has often compared himself to a baseball batter waiting for the perfect pitch. In baseball, a batter can let any number of pitches go by without being called out. The batter does not have to swing at every pitch. He can wait and wait and wait until the perfect pitch comes along, and then swing hard. An investor does not face a similar constraint. You do not have to buy something every day or every month. You can sit on cash, watching, evaluating, waiting. And when the perfect opportunity appears, when a great business becomes available at a great price, you swing hard. You invest a meaningful amount, and then you hold. Now, what creates these moments of opportunity? There are two main sources of buying opportunities for the Buffett investor. The first is broad market downturns. Sometimes the entire stock market falls sharply. Economic recessions, financial crises, geopolitical shocks, pandemics, and other events of fear and uncertainty cause investors to sell broadly and indiscriminately. Great businesses fall alongside mediocre ones, and in those moments, the Buffett investor does not panic and sell. Instead, the Buffett investor gets excited. Because if a great business has fallen sharply in price, and its fundamental competitive advantage is intact, and its long-term earnings prospects are unchanged, then the price decline has simply created an opportunity to buy more at a better price. This is counterintuitive for most investors. Most people feel fear when prices fall. They want to sell to protect what they have left. But the Buffett investor understands that price and value are two different things. A great business that has fallen in price has not necessarily fallen in value. Its competitive advantage is still there. Its ability to earn money in the future is still largely intact. And so a lower price simply means you are getting more value for your money. Buffett famously said to be fearful when others are greedy and greedy when others are fearful. This is not just a clever saying. It is a description of how he actually operates. When the market is panicking, he is calmly buying. When the market is euphoric and overvalued, he is patiently sitting on cash. The second source of buying opportunities is business-specific problems. Sometimes a great business faces a temporary challenge that causes its stock price to fall sharply. Perhaps it has a bad quarter. Perhaps there is a scandal involving management. Perhaps a competitor has entered the market and investors are worried about the future. Perhaps there has been some negative news that has spooked the market. The key word here is temporary. If the underlying competitive advantage of the business is still intact, if the fundamental economics of the business are still strong, then a temporary problem is just that. Temporary. And a temporary problem that causes a permanent-looking price decline is exactly the kind of opportunity that Buffett has built his career around. Mary Buffett and David Clark walk you through how to evaluate these situations. How do you tell the difference between a temporary problem and a permanent one? How do you know whether the competitive advantage is still intact? These are critical questions, and the answers often require you to think carefully about the nature of the business, the source of its competitive advantage, and whether the current problem threatens that advantage at its core. But the general principle is clear. A price decline caused by a temporary business-specific problem in a company whose fundamental competitive advantage is still strong is a buying opportunity, not a reason to flee. Now let us talk about some of the specific tests that Buffett and the authors suggest applying to any business you are considering investing in. These are not rigid rules that must each be perfectly satisfied. They are a framework, a set of questions to ask that will help you build up a complete picture of whether a business is truly great or merely good or even mediocre. The first test is the earnings per share growth test. Has the company grown its earnings per share consistently over the past 10 years? Is the trend clearly upward? Are there any years of serious decline? What was the annualized rate of growth over the full period? Higher and more consistent growth is better. You want to see a business that has been reliably growing its earnings for a decade. The second test is the return on equity test. Has the company consistently earned high returns on equity? Is the return on equity substantially higher than what you would expect from an average business in a competitive industry? Has it been consistently high over many years, not just in one or two exceptional years? The third test is the debt test. Does the company carry substantial long-term debt? How many years of earnings would it take to pay off all long-term debt? A business with little or no long-term debt is much stronger than one burdened by borrowing. The fourth test is the retained earnings test. Does the company retain a meaningful portion of its earnings? And what does it do with those retained earnings? Does it invest them in ways that generate high returns? Or does it squander them on poor acquisitions or unnecessary expenditures? The fifth test is the gross profit margin test. A business with a durable competitive advantage generally has a high gross profit margin, meaning that after paying for the direct costs of producing its products or services, it is left with a large proportion of revenue as gross profit. A high gross profit margin is a sign of pricing power. It tells you that customers are willing to pay a price that is significantly above the cost of production, which in turn suggests that the product or service has qualities that customers value highly and cannot easily find elsewhere. The sixth test is the selling and administrative expenses test. Even a business with a high gross profit margin can destroy its earnings if it has to spend enormous amounts on advertising, marketing, and administration just to maintain its competitive position. A business with a true, durable competitive advantage generally does not have to spend proportionally large amounts on selling and administrative expenses. Its brand and its market position are self-reinforcing. Customers already know about it. They already prefer it. They already come back for it. And so the business does not have to work as hard as a commodity competitor to keep its customers. The seventh test is the research and development test. Some businesses have competitive advantages that are based primarily on patents or proprietary technology. The problem with this kind of competitive advantage is that it can be fragile. Patents expire. Technology can be superseded. A competitor can invest in research and develop a better product. Warren Buffett tends to be cautious about businesses whose competitive advantage depends heavily on ongoing research and development spending, precisely because such businesses can lose their advantage more easily. He much prefers competitive advantages rooted in brand loyalty, consumer habit, and switching costs, because those tend to be much more durable and much harder for competitors to attack. The eighth test is the capital expenditure test. How much does the company have to spend on maintaining and upgrading its physical assets each year just to stay competitive? A business that has to spend a large proportion of its earnings on capital expenditures every year has less money available to compound for its shareholders. A business with a durable competitive advantage often requires relatively modest capital expenditures to maintain its competitive position. Once the infrastructure is in place, it does not need constant, expensive upgrades. And so, more of its earnings are truly free to compound for the benefit of shareholders. The ninth test is the consistency test. Has the business been operating essentially the same way for many years? Businesses that have to constantly reinvent themselves, constantly develop new products, constantly respond to changing competitive threats, are generally not businesses with strong, durable competitive advantages. The best Buffett businesses are ones that are doing essentially the same thing they were doing 10 or 20 years ago, just more of it, more profitably. Consistency is a sign of stability, and stability is a sign of a strong competitive position. The 10th test is the ability of management to allocate capital effectively. This is perhaps the most subtle of the tests, but it is very important. Even a great business can be damaged by management that allocates its earnings poorly. If management takes the abundant cash that a great business generates and wastes it on bad acquisitions, ego-driven projects, or excessive executive compensation, it destroys value for shareholders. Buffett has always paid close attention to management quality, not just in terms of operational excellence, but in terms of what management does with the money the business generates. The best managers are those who understand that their job is to allocate capital in ways that maximize long-term returns for shareholders. They are rational, honest, and focused on the fundamental economics of the business. They do not chase growth for its own sake. They do not make acquisitions to boost their own power or prestige. They do not pay themselves obscene salaries at shareholders' expense. They simply focus on running the business well and putting the money it generates to the best possible use. Finding a great business with great management is the ideal combination. And when you find both, you have found something truly rare and valuable. Now, let us talk about what kind of businesses Warren Buffett avoids. Understanding what he avoids is just as important as understanding what he seeks. Because a lot of investors make the mistake of buying businesses that look superficially attractive but have fundamental characteristics that make them poor long-term investments. The first type of business Buffett avoids is what he and the authors call commodity businesses. These are businesses that sell products or services that are essentially indistinguishable from what their competitors offer. Steel producers, chemical manufacturers, airline companies, textile mills, paper producers, construction materials companies. In all of these industries, the basic product that one company sells is not meaningfully different from the basic product that every other company in the industry sells. Steel is steel. An airline seat from one carrier to a given destination is essentially the same as an airline seat from another carrier on the same route. And when customers cannot see a meaningful difference between your product and a competitor's product, they choose on price. And when they choose on price, you are in a constant race to the bottom. Every competitor is trying to produce more cheaply, and customers are always looking for the cheapest option. Profits get squeezed, returns on equity are modest, and the entire industry goes through cycles of boom and bust, with good years when demand is high and competitors are few, followed by terrible years when demand falls or new capacity enters the market. These cycles are unpredictable, and because they are unpredictable, investing in commodity businesses requires either an ability to time these cycles, which very few people can do reliably, or an acceptance of very volatile and mediocre long-term returns. Buffett simply stays away from commodity businesses. He recognizes that no matter how cheap a commodity business looks, the fundamental economics work against long-term compounding. The second type of business Buffett avoids is capital-intensive businesses in general. We touched on this in the capital expenditure test, but it is worth expanding on. A business that requires huge ongoing capital expenditures to maintain its competitive position is consuming a large portion of its earnings just to stand still. It cannot freely compound those earnings for shareholders. Think about businesses that have to constantly replace expensive machinery, constantly upgrade their technology infrastructure, constantly build new physical capacity just to keep up with competitors. These businesses face a perpetual drain on their earnings, and this drain significantly limits their ability to create compounding returns for shareholders over time. By contrast, a business that can maintain and grow its competitive position with relatively modest capital expenditure is able to channel much more of its earnings into compounding, whether through retained earnings invested in growth, buybacks of its own stock, or dividends. The third type of business Buffett avoids is businesses in industries undergoing rapid change. When an industry is changing very fast, when new technologies are disrupting old business models, when customer preferences are shifting rapidly, it becomes very difficult to know whether the competitive advantage of any particular business will survive.
The company that dominates the market today may be irrelevant in 10 years because the entire basis of competition has changed. Buffett famously says that he stays within his circle of competence. This means he only invests in businesses and industries that he thoroughly understands. He is not afraid to say that he does not understand a particular technology or industry. And when he does not understand something, he simply does not invest in it, no matter how exciting it looks. This is a form of intellectual humility that most investors lack. Most investors fear missing out on exciting new trends and technologies. They rush into industries they do not understand, chasing the promise of big returns. And often they get burned because they did not understand the competitive dynamics, the risks, or the fundamental economics of the businesses they were buying. Buffett simply waits. He waits for opportunities in businesses he understands deeply, businesses where he can clearly see the durable competitive advantage, where he can reliably project the future earnings, and where the price is right. And then he acts decisively. This combination of patience, deep understanding, and decisive action when the moment is right is the essence of the Buffett approach. Now let us talk about something that trips up many investors. It is the question of price to earnings ratios. Most investors know about price to earnings ratios, but many use them incorrectly. They look at a business and say the price to earnings ratio is too high, and they walk away. Or they say the price to earnings ratio is low, and they think they have found a bargain. But this kind of simple-minded analysis misses the most important dimension of price to earnings evaluation. And that dimension is growth. A business that has modest earnings today, but is growing those earnings very fast, may justify a higher price to earnings ratio than a business with higher earnings today, but no growth. Because what you are ultimately paying for is not just today's earnings. You are paying for all the future earnings that the business will generate over many years. And if those future earnings are going to grow dramatically, you should be willing to pay more for them today. The Buffett approach accounts for this by looking at the projected compounding rate of return over time. Here is how to think about it. If a business is growing its earnings per share at a certain rate per year, and you pay a certain price for that business today, you can project what the earnings per share will be in 10 years. And if you apply a reasonable price to earnings multiple to that projected earnings per share, you can project what the stock might be worth in 10 years. That gives you your projected return on your investment, and you can compare that projected return to what you could earn in alternative investments, whether bonds, other stocks, or simply keeping the money in cash. If the projected return from the great business is substantially higher than what you could earn elsewhere, and if the assumptions underlying that projection are sound, then it is worth paying what the market is asking. This kind of forward-looking analysis is much more powerful than simply looking at the current price to earnings ratio and deciding whether it feels cheap or expensive. Of course, it requires making assumptions about future growth rates, and those assumptions can be wrong. This is why the quality and durability of the competitive advantage matters so much. The more durable the competitive advantage, the more reliable the earnings growth has been historically, the more confident you can be in projecting that growth into the future. And the more confident you are in the growth projection, the more comfortable you can be paying a higher price to earnings ratio. A mediocre business at a cheap price gives you uncertain future earnings at a low price. A great business at a fair price gives you reliable, growing future earnings at a reasonable price. Over long periods of time, the great business at a fair price vastly outperforms the mediocre business at a cheap price. This is the core insight that distinguishes the Buffett approach from simple value investing in the Graham tradition. It is not just about buying cheap, it is about buying great at fair prices. Let us now talk about a concept that is central to the practical decision-making process of the Buffett investor. It is the concept of what happens to retained earnings over time. Mary Buffett and David Clark walk through a simple but powerful way of thinking about this. When a business retains its earnings, instead of paying them out as dividends, those retained earnings become part of the equity base of the business. And in a business with a durable competitive advantage, that equity base earns a consistently high return. So the retained earnings generate more earnings. And those additional earnings are also largely retained, and they generate still more earnings. Year after year, the compounding effect grows. The business that was earning a certain amount per share in year 1 is now earning a significantly larger amount per share in year 10 because the retained earnings have been constantly added to the equity base and have been earning at a high rate of return throughout. This is why Buffett says that the truly great businesses are those that can reinvest their retained earnings at high rates of return. And this is why he has historically preferred to hold businesses for very long periods of time rather than selling them. Every year that passes, the retained earnings compound. Every year, the equity base grows. Every year, the earnings per share increase. And the longer you hold, the more powerful the compounding becomes. This is also why Warren Buffett has famously said that his favorite holding period is forever. He does not mean this completely literally. He will sell a business if the competitive advantage has been permanently impaired, or if the price offered by the market is so extraordinarily high that it would take many decades to realize a reasonable return, or if he finds a far superior use for the capital. But the general preference is to hold, because selling means giving up the future, compounding that the business would have generated, and then trying to find a new investment that can compound as well. And truly, great businesses with durable competitive advantages are rare. When you have found one and bought it at a reasonable price, you do not want to let it go easily. Now let us talk about what to do with the cash that great businesses pay out. Even great businesses that retain a large portion of their earnings often pay out some dividends. And when they do, you receive cash that you need to put to work. In the Buffett model, this cash should ideally be reinvested in great businesses at great prices. If there are no such opportunities available, you hold the cash patiently. The worst thing you can do is reinvest the cash into mediocre businesses just because you feel you need to put it to work. Patience with cash is as important as patience in finding opportunities. Because deploying cash into bad investments does not just fail to earn good returns, it actively destroys value. It ties up your capital in businesses that cannot compound it well. And it means you have less capital available when a great opportunity does eventually appear. This is a discipline that most investors find very hard to maintain. The pressure to do something, to put your money to work, is psychologically powerful. Sitting on cash can feel like laziness or missed opportunity. But when the opportunity finally appears, the patience will have been worth it, because you will have the capital to move decisively. Let us now talk about one of the most important practical skills in the entire approach. It is the skill of evaluating management. We mentioned management quality earlier, but it deserves a deeper exploration. The management team of a business has two main jobs. The first is to run the existing business operations as efficiently and effectively as possible. The second is to allocate the capital that the business generates. That second job, capital allocation, is the one that most investors and even most analysts give insufficient attention to. But it is perhaps the most important determinant of long-term returns for shareholders. Think about what management does with the profits of the business. Does it invest in high-return projects that grow the business's earnings? Does it make acquisitions that add genuine value? Does it buy back its own stock when the stock is undervalued? Does it pay out dividends when there are no good investment opportunities? Or does it do the opposite? Does it make acquisitions that destroy value because management is empire building? Does it buy back stock at overvalued prices, wasting shareholder money? Does it pay excessive dividends at times when the cash could have been better invested internally? Does it pursue growth for its own sake rather than for the sake of shareholder value? The history of corporate management is littered with examples of brilliant operators who destroyed shareholder value through poor capital allocation. Companies that ran great businesses but made terrible acquisitions that wiped out years of earnings. Companies that bought back their own stock at peak prices and then had to issue new stock at depressed prices to survive a downturn. Companies that paid out most of their earnings as dividends when they could have reinvested those earnings at very high rates of return. The best management teams are disciplined, rational, and shareholder-focused. They understand the economics of their business deeply. They are honest about its strengths and limitations. They communicate clearly and transparently with shareholders. They set realistic expectations and then consistently meet or beat them. And they make capital allocation decisions that consistently increase the long-term value of the business. Evaluating management quality is not purely a quantitative exercise. It requires reading what management says, listening to how they talk about the business, and watching what they actually do over time. Look at their track record. How have they allocated capital over the past decade? Have the acquisitions they have made turned out well? Have the capital expenditure programs they have pursued generated good returns? Have they been honest when things went wrong? Have they taken responsibility for mistakes or deflected blame? Great managers are rare. But when you find a great business run by great management, you have found something that can compound wealth reliably for a very long time. Now let us turn to another key concept that the book explores. It is the idea of the equity bond and how to use it to calculate projected returns. We introduced this concept earlier, but now let us go deeper. The basic idea is this. When you buy a share of a great business at a certain price, you are essentially purchasing a stream of future earnings. Those earnings will flow to you each year in the form of retained earnings that compound your ownership stake and in the form of any dividends paid out. And in a business with a durable competitive advantage, those earnings will grow each year. So unlike a traditional bond, where the interest payment is fixed, this is like a growing bond. The payment starts at a certain level and grows each year. And because it grows, the effective return on your fixed purchase price grows each year. To calculate your projected return from this kind of investment, you need to make a few estimates. First, you need to know the current earnings per share of the business. Second, you need to estimate the rate at which those earnings per share will grow over the next decade. This estimate should be based on the historical growth rate, adjusted for any changes in the business's competitive environment. Third, you need to apply a reasonable price to earnings multiple to the projected earnings per share in 10 years to estimate the price of the stock in 10 years. And then, you can calculate the compounded annual return that you would earn if you bought at today's price, and the stock reached that projected price in 10 years. If that projected return is substantially higher than what you could earn in a safe alternative, like high-quality bonds, then the investment may make sense. If the projected return is similar to or lower than what you could earn in safer alternatives, then the investment does not make sense, even if the business is a great one. Because remember, in the Buffett approach, you are not just looking for great businesses. You are looking for great businesses at prices that give you superior returns. The price you pay matters enormously. It is the other half of the equation. A great business at a terrible price is a bad investment. A great business at a fair or discounted price is a great investment. Now let us talk about the market and how to use it. One of the most important things Warren Buffett has always said is that the stock market is there to serve you, not to guide you. What he means is this. The stock market is a mechanism for buying and selling shares. It sets prices every day based on the collective emotions, opinions, and short-term thinking of millions of investors. And those prices are often wrong. Sometimes dramatically wrong. In the short term, stock prices are driven by news, sentiment, fear, greed, momentum, and a dozen other factors that have nothing to do with the fundamental long-term value of the businesses being priced. This creates opportunities. When the market is in a panic, it often prices great businesses far below their true long-term value. When the market is euphoric, it often prices businesses far above their true long-term value. In both cases, the market is wrong. And the investor who understands this, who has done the work to understand the true long-term value of a great business, can take advantage of these moments of market irrationality. In a downturn, they buy. In a period of euphoria, they either hold what they already own or they wait patiently, not buying, until prices come back down to reasonable levels. This requires an ability to think independently of the crowd. It requires the confidence to act differently from what everyone else is doing. And it requires the emotional stability to resist the fear of falling prices and the greed of rising ones. These are psychological challenges that most investors struggle with. The urge to follow the crowd is powerful. It feels safer to do what everyone else is doing. But in investing, what feels safe is often not what is most profitable. And what feels terrifying, like buying when prices are falling and everyone is selling, is often what creates the greatest long-term returns. Buffett has described the market participant as Mr. Market, a character originally invented by his mentor, Benjamin Graham. Mr. Market comes to you every day and offers to buy your shares or sell you his shares at a price. Some days, he is euphoric and offers you an absurdly high price for your shares. Some days, he is deeply depressed and offers to sell his shares to you at an absurdly low price. And on most days, his prices are somewhere in between. The wise investor does not let Mr. Market's moods determine what they think their shares are worth. The wise investor knows what the shares are worth based on careful analysis of the underlying business. And the wise investor uses Mr. Market's moods to their advantage. When Mr. Market is depressed and offers bargain prices, the wise investor buys. When Mr. Market is euphoric and offers high prices, the wise investor considers selling, or at least does not buy more. And when Mr. Market's prices are roughly fair, the wise investor simply holds their great businesses and lets the compounding continue. Now let us turn to some other important practical considerations. One of them is the question of diversification. The conventional wisdom in investing is that you should diversify widely. Own many different stocks across many different industries. This way, if any one stock collapses, it only represents a small portion of your portfolio, and your overall portfolio is protected. And for the average investor who does not have the time or knowledge to deeply analyze individual businesses, broad diversification is indeed sensible advice. But for the true Buffett investor, the approach to diversification is different. Buffett has often said that diversification is protection against ignorance. What he means is that if you truly understand a business, if you have done the deep analysis to verify that its competitive advantage is durable, that its earnings are growing reliably, that management is excellent, and that the price is fair, then you do not need to spread your bets widely to protect yourself against ignorance. You can concentrate your capital in the handful of truly great businesses that you understand deeply and that are available at attractive prices. Of course, this approach requires a higher level of knowledge and analytical work than simply buying a diversified index fund. And it requires the emotional fortitude to hold concentrated positions through market downturns. But for the investor who is willing to put in that work and develop that fortitude, the potential returns from concentrating in great businesses at fair prices over long periods of time are extraordinary. This is not a recommendation to be reckless. Even Buffett typically owns positions in multiple businesses. But the principle is that quality of analysis and quality of businesses should take priority over quantity of diversification. 10 great businesses understood deeply are better than 100 mediocre businesses understood superficially. Now, let us talk about taxes. One of the great, but often overlooked advantages of the Buffett approach is its tax efficiency. Most investors trade actively. They buy and sell stocks frequently, and every time they sell a stock at a profit, they pay taxes on that gain. This constant tax drag significantly reduces their compounding returns over time. But the Buffett investor buys great businesses and holds them for many years, often decades. As long as you hold a stock, you do not pay capital gains taxes on the unrealized gain. The gain keeps growing, tax deferred, for as long as you hold. This effectively gives you the use of the government's share of the gain for all those years. And over long periods of time, the benefit of this tax deferral can be very substantial. The compounding of your full investment without annual tax drags is more powerful than the compounding of your investment after annual tax deductions. This is another reason why long holding periods are so beneficial in the Buffett model. They are not just about letting the business compound. They are also about keeping the tax drag as low as possible for as long as possible. Let us now explore some of the ways that new investors often go wrong and how the Buffett approach avoids those pitfalls. The first common mistake is buying businesses they do not understand. Many investors buy stocks based on tips, headlines, or the simple fact that the stock price has been going up. They do not understand the fundamental economics of the business, where its profits come from, why its competitive position is strong or weak, or what might change the outlook for the business in the future. Without this understanding, they have no rational basis for deciding whether the price they are paying is fair, whether the business is likely to continue growing, or whether the competitive advantage is durable. They are essentially guessing. And while guessing can work in a rising market, it tends to produce terrible results when the market turns or when a specific business faces challenges. The Buffett investor only buys what they thoroughly understand. If they cannot clearly explain why a business has a durable competitive advantage, how it earns its profits, and why those profits are likely to grow over time, they simply do not buy. The second common mistake is short-term thinking. Most investors think in terms of months. What will this stock do in the next quarter? When will the next positive news catalyst come? Is this a good time to buy before earnings? This kind of thinking is fundamentally incompatible with the Buffett approach. The Buffett investor thinks in terms of decades. What will this business look like in 10 years? What will its earnings per share be in 15 years? How will the competitive landscape have evolved? Will the competitive advantage still be intact? Short-term thinking leads to short-term behavior, frequent trading, emotional decisions, and the destruction of compounding through taxes and transaction costs. Long-term thinking leads to patient holding, lower taxes, and the full benefit of compounding over time. The third common mistake is focusing on the wrong financial metrics. Many investors focus on revenue growth rather than earnings growth. They get excited about companies that are growing their revenues rapidly without paying enough attention to whether those revenues are actually generating profits. Or they focus on price-to-book ratios, or revenue multiples, or other metrics that are less directly relevant to the fundamental question of how much money the business is earning and how fast those earnings are growing. The Buffett metrics are simple: earnings per share growth, return on equity, debt levels, free cash flow. These are the numbers that tell you whether a business is truly great. Everything else is secondary. The fourth common mistake is letting emotions drive decisions. We talked about the psychological challenges of the Buffett approach, but it is worth emphasizing again. The biggest enemy of the long-term investor is their own emotions. Fear causes investors to sell great businesses at low prices, locking in losses and missing the recovery. Greed causes investors to buy mediocre businesses at high prices, chasing recent performance and setting themselves up for poor future returns. Overconfidence causes investors to concentrate too heavily in a single business without doing adequate analysis to verify that the competitive advantage is truly durable. And impatience causes investors to trade frequently, destroying returns through taxes and transaction costs. The Buffett investor is calm, rational, and disciplined. They make decisions based on analysis, not emotions. They are not swayed by what everyone else is doing. They are not panicked by short-term price movements, and they are patient enough to wait for the right opportunities and then hold their positions for the long term. This kind of emotional discipline is one of the rarest and most valuable skills in investing, and it is something that can be developed with practice and education. The fifth common mistake is constantly looking for the next big thing. Many investors are perpetually chasing the newest, most exciting investment opportunity. They are always looking for the next revolutionary technology, the next transformative trend, the next company that is going to change the world. And while some of these exciting new businesses do turn out to be great investments, many more turn out to be disappointments, because excitement and visibility attract competition. And when many companies are competing in an exciting new space, it is very hard to predict which one will ultimately dominate and whether the competitive advantages of the winners will be truly durable. The Buffett investor prefers boring. They prefer the company that has been dominant in its space for 20 years and is likely to remain dominant for another 20 years. They prefer the business that does not generate exciting headlines, that operates in an industry that most people do not find glamorous, but that quietly compounds its earnings year after year, decade after decade. This preference for boring reliability over exciting uncertainty is one of the counterintuitive hallmarks of the Buffett approach, and it has generated extraordinary long-term returns. Now let us talk about something that is particularly relevant for investors in different parts of the world. The principles of the Buffett approach are universal. They apply in every country, every market, every economic environment. The fundamental logic of buying great businesses with durable competitive advantages at fair prices and holding them for long periods is as valid in Asia as it is in North America, as valid in developing markets as in developed ones, as valid in times of high inflation as in times of low inflation. Of course, the specific businesses that qualify as great will differ from market to market, and the specific competitive advantages that are most durable may vary depending on local conditions, regulations, and consumer behavior. But the underlying framework is the same. Find businesses that dominate their markets. Find businesses that earn consistently high returns on equity. Find businesses with growing earnings per share. Find businesses with low debt. Find businesses run by excellent management. Pay a fair price. Hold for the long term. And let compounding do its work. These principles are not complex. They do not require advanced mathematical training. They do not require access to privileged information. They do not require sophisticated technology or algorithms. They require clear thinking, a willingness to do careful analysis, patience, and emotional discipline. And those qualities are available to anyone who is willing to develop them. Let us now explore some of the more nuanced aspects of how Buffett thinks about specific industries and business types. One industry that Buffett has famously avoided for most of his career is the airline industry, and the reasons he has avoided it perfectly illustrate the commodity business problem. Airlines sell essentially the same product, a seat on a plane from one city to another. And because the product is essentially identical from one airline to another, customers choose primarily on price. This means airlines are in constant price competition. And because the costs of running an airline are very high, and because a significant portion of those costs, like fuel prices, are outside the control of the airline, profitability is constantly squeezed. Airlines also require enormous capital expenditures. Planes are extraordinarily expensive. They must be constantly maintained and eventually replaced. And the technology of aircraft is constantly advancing, meaning that today's planes will be superseded by more efficient models in the future, requiring further capital investment. The combination of intense price competition, high fixed costs, and enormous ongoing capital expenditures makes the airline industry a notoriously difficult one for long-term investors. Buffett made an exception during the period when airlines seemed to be consolidating and improving their economics, but he ultimately concluded that the fundamental competitive dynamics of the industry made it unsuitable for the kind of long-term compounding investment he prefers. This example illustrates an important principle. Even industries that seem essential to modern life, industries without which the modern economy could not function, can be poor long-term investments. Because the investment returns depend not on how important the industry is, but on the competitive dynamics within it. An essential service that is provided by dozens of competitors fighting on price generates poor returns for investors, even though the service itself is critical. Conversely, a non-essential product with a powerful brand and no serious competition can generate spectacular long-term returns. The Buffett investor always focuses on the competitive economics, not the importance or excitement of the industry. Let us now talk about another important concept. It is the idea of intrinsic value. Intrinsic value is the true economic worth of a business, not the price that the market is currently assigning to it, but the actual value based on the future cash flows that the business will generate over its lifetime, discounted back to today. Now, intrinsic value is not a precise number. It is an estimate. It requires assumptions about future earnings growth, about the durability of the competitive advantage, about management quality, and about the appropriate discount rate to use in bringing those future cash flows back to a present value. Because it is an estimate rather than a precise calculation, different investors can arrive at quite different intrinsic values for the same business. But the principle is simple. If the market price of a business is significantly below your estimate of its intrinsic value, there is a margin of safety. You are getting the business at a discount. And that margin of safety is important because it provides protection against errors in your analysis. Even if your estimates of future earnings turn out to be a little too optimistic, or if the competitive advantage turns out to be a little less durable than you expected, you still have a reasonable chance of earning a good return because you paid a price well below what the business was fundamentally worth. Conversely, if you pay a price at or above your estimate of intrinsic value, you have no margin of safety. Even a small shortfall in earnings growth or a slight weakening of the competitive advantage can lead to poor investment returns. This concept of margin of safety is another one that comes from Benjamin Graham, and it is one that Buffett has kept as a cornerstone of his approach, even as he has evolved beyond Graham in other ways. The Buffett approach tries to buy great businesses with a margin of safety. Great businesses at fair prices, or even better, at discounted prices. Not mediocre businesses at bargain prices. Not great businesses at whatever price the market happens to be asking. Great businesses at prices that provide a meaningful margin of safety. This is the sweet spot. And finding it requires patience because it does not always exist. There are long periods when great businesses are priced fairly or even expensively by the market, and no significant margin of safety is available. In those periods, the Buffett investor waits. They do not lower their standards. They do not convince themselves that a mediocre business is actually great. They simply wait, knowing that eventually the market will present the opportunity they are looking for. And when it does, they will be ready. Now let us talk about the compounding of wealth over time and why patience and time horizon are so crucial to the Buffett approach. The magic of compounding is something that most people intellectually understand, but emotionally underestimate. The idea that money, growing at a consistent rate over a long period, can multiply dramatically is one of those mathematical facts that seems almost unbelievable until you actually work through the numbers. Consider this. Money growing at a consistent annual rate will roughly double every certain number of years, depending on that rate. At a lower rate, it takes longer to double. At a higher rate, it doubles more quickly. But in both cases, the key insight is that each doubling adds more in absolute terms than the previous one. In the early years, the compounding may not seem impressive, but as time goes on, the absolute amounts being added each period grow larger and larger. And after many decades, the accumulated wealth can be truly astonishing. This is why Buffett has often said that his wealth is largely the product of living in a great country, finding great businesses, and having time on his side. The time dimension of compounding is as important as the rate of return. A high rate of return over a short period may generate less wealth than a moderate rate of return over a very long period. Because the longer the compounding period, the more powerful the effect of time. This is why Buffett started investing so young, and why he has always reinvested almost everything rather than consuming his returns. He has been giving compounding as much time as possible to do its work. For the investor who starts later in life, or who needs to consume some of their returns along the way, the compounding period is shorter, but the principle is still the same. Every additional year of compounding adds value. Every dollar consumed prematurely reduces future compounding. And every investment made in a poor quality business at a high price is a drag on compounding that is very hard to recover from. The time you spend waiting for the right opportunity is not wasted. It is the time that your existing great businesses are compounding. And the moment you invest in a mediocre business at a high price, you are interrupting that compounding and starting a new, inferior compounding sequence. This is why discipline in investment selection is so critical to long-term wealth creation. Every investment decision is a compounding decision. It determines the rate at which your wealth will grow from that point forward. And the best compounding decisions are the ones made in great businesses at fair prices. Now let us talk about the practical steps to becoming a Buffett-style investor. The first step is education. You need to thoroughly understand the principles we have been discussing, not just the surface rules, but the deep logic beneath them. Why do durable competitive advantages generate superior returns? Why does consistent return on equity indicate a strong competitive position? Why are retained earnings more valuable in a great business than in a mediocre one? Why is long-term holding more tax efficient and more compounding friendly than frequent trading? Understanding the logic behind the rules is what allows you to apply them intelligently in real situations, rather than just following them mechanically. The second step is building your circle of competence. This means becoming a genuine expert in a limited number of industries and business types. You do not need to understand every industry. You just need to understand the ones in which you invest. Pick a handful of industries that you are genuinely interested in, that you use products or services from, that you have some professional familiarity with, or that you find intellectually engaging. And then study them deeply. Learn who the major players are. Learn the competitive dynamics. Learn what drives profitability. Learn what the key risks are. Learn which businesses in the industry have genuine competitive advantages and which are fighting it out in a commodity struggle. The deeper your understanding of an industry, the better equipped you are to identify the great businesses within it and to evaluate them intelligently. The third step is screening. Once you understand the principles and have built your circle of competence, you need to find businesses that meet the Buffett criteria. Look at the 10-year earnings per share history. Look at the return on equity. Look at the debt levels. Look at the free cash flow generation. Look at the gross profit margins. These screens will quickly eliminate the vast majority of publicly traded businesses. Most businesses do not have durable competitive advantages. Most businesses do not have consistently growing earnings. Most businesses do not earn high returns on equity over many years, but some do. And those are the ones worth investigating further. The fourth step is deep analysis. For each business that passes the initial screening, you need to go deeper. Understand the source of the competitive advantage. Is it a brand? A switching cost? A regulatory monopoly? A network effect? Understand how durable that advantage is. Has it held up for decades? Does it face meaningful threats? Understand the management team. How have they allocated capital historically? Are they honest and shareholder-focused? Do they have a track record of making good decisions over long periods? Understand the risks. What could go wrong? What could undermine the competitive advantage? What external forces could change the economics of the business? The fifth step is valuation. Once you have identified a business that you believe has a durable competitive advantage, and once you have done the deep analysis to understand the business thoroughly, You need to determine what price you should be willing to pay. Use the initial rate of return calculation. Use the projected compounding rate of return. Estimate the intrinsic value, and determine what margin of safety exists at current prices. If the margin of safety is substantial, and if all the other criteria are met, you have found an opportunity. The sixth step is acting with conviction. When you have done the work and found the opportunity, you need to act decisively. Do not waver. Do not second-guess yourself. Do not wait for more certainty, because more certainty will never come. Invest a meaningful amount. Not so much that a single bad outcome would devastate you, but enough that the investment can make a real difference to your overall returns. The seventh step is holding with discipline. Once you have made your investment, resist the urge to constantly monitor the short-term price movements. Trust your analysis. Trust the business. Trust the compounding. Check in periodically to make sure the fundamental competitive advantage is still intact, that management is still doing a good job, and that nothing fundamental has changed. But do not get distracted by day-to-day price fluctuations. They are noise. The signal is the long-term progression of the business's earnings per share. As long as that is still growing, as long as the competitive advantage is still intact, hold. The eighth step is patience. Between opportunities, wait. Do not lower your standards to stay active. Do not buy something just because you have cash to invest. Wait for the right combination of quality and price. It will come. Markets are volatile. Economic cycles create downturns. Individual businesses face temporary challenges, and in those moments, opportunities will appear. Be ready for them. Have the cash available. Have the analysis done, so that when the opportunity arrives, you can move quickly and confidently. Let us now revisit the 10 tests that Buffett-style investors apply when evaluating any potential investment, this time in a more integrated way that shows how they all fit together into a coherent picture. The tests are not checklist items to be evaluated independently. They are interconnected dimensions of the same fundamental question. Does this business have a durable competitive advantage that will allow it to consistently compound earnings for shareholders over many years? When a business consistently grows its earnings per share over many years, it is showing you that the competitive advantage is real and durable. When it consistently earns high returns on equity, it is showing you that the competitive advantage is translating into exceptional financial performance. When it carries little debt, it is showing you that its earnings are sufficient to fund its operations without borrowing, a sign of healthy, underlying economics. When it retains meaningful earnings and reinvests them at high rates of return, it is compounding your wealth automatically. When it has high gross profit margins, it is showing you that customers value its products or services enough to pay a significant premium above production cost. When it does not spend disproportionately on selling and administrative costs, it is showing you that its brand and market position are self-sustaining. When it does not rely heavily on research and development, it is showing you that the competitive advantage is rooted in durable factors like brand and customer loyalty, rather than an easily displaced technological advantage. When it requires modest capital expenditures to maintain its competitive position, it is showing you that most of its earnings are truly free to compound for shareholders. When it has been operating in a consistent way for many years, it is showing you the stability that is characteristic of strong competitive positions. And when its management has a track record of excellent capital allocation, it is showing you that the wealth being created by the business's competitive advantage is being intelligently deployed to create even more wealth. When all of these characteristics come together in a single business, and when that business is available at a price that provides a fair or better return, you have found what Buffett is looking for. You have found the ideal investment. And the beauty of this approach is that once you have found such a business and purchased it at a fair price, the investment largely takes care of itself. You do not need to monitor the news constantly. You do not need to respond to every market move. You do not need to trade actively. You simply hold, and let the business do what great businesses do over long periods of time. They compound, they grow, they generate wealth, and they do it quietly, reliably, year after year, regardless of what the market is doing in any given period. Now let us take a step back and think about why this approach is so different from what most people do when they invest, and why that difference is so important. Most people who invest in the stock market are, in one way or another, speculating. They are trying to predict where prices will go in the short term. They are responding to news, to analyst upgrades, to earnings reports, to economic data, to central bank announcements. They are looking for patterns in price movements. They are trying to buy before other people buy and sell before other people sell. This kind of activity looks like investing, but is actually closer to gambling. Because the short-term price movements of stocks are influenced by so many factors, many of them random or unpredictable, that no one can reliably predict them over time. The research on active trading is damning. Most active traders underperform the market. Most hedge funds underperform the market. Most stock-picking analysts underperform the market. Not because these people are not intelligent or hardworking, but because predicting short-term price movements is extremely difficult, and the costs of getting it wrong, in terms of taxes, transaction costs, and missed compounding, add up quickly. The Buffett approach sidesteps all of this. It does not try to predict short-term price movements. It does not try to time the market. It does not try to identify the next big trend before everyone else does. It simply tries to identify businesses with durable competitive advantages, verify that they are priced fairly, and hold them for very long periods. This is a fundamentally different activity from what most market participants are doing. And it is an activity where patience, careful analysis, and emotional discipline are rewarded, rather than speed, information access, and short-term prediction ability. For the thoughtful, patient investor who is willing to do the necessary analytical work, this approach offers a genuine edge. Because most market participants are not doing this. They are focused on the short term. They are responding to the latest news. They are following the crowd. And this means that opportunities for the long-term, fundamentals-focused investor are regularly created by the activity of short-term speculators. When short-term speculators panic and sell a great business, they create a buying opportunity for the long-term investor. When short-term speculators get excited about a mediocre business and drive its price to absurd levels, they create a selling opportunity for the long-term investor who already owns it. The Buffett investor is always aware of this dynamic. They are always looking at what the short-term crowd is doing, not to follow it, but to assess whether it is creating opportunities to buy great businesses cheap or to sell overvalued holdings at high prices. And in this way, the activity of the speculative crowd, which creates so much chaos and frustration for most investors, becomes a source of opportunity for the Buffett investor. Let us now talk about something very practical. How do you find the information you need to apply these principles? In the modern world, the financial information needed to evaluate a business using Buffett-style analysis is readily available. Public companies file detailed financial reports with regulatory authorities. These reports contain everything you need. The income statement shows you revenues, costs, and earnings. The balance sheet shows you assets, liabilities, and equity. The cash flow statement shows you how much cash the business is actually generating. And the notes to the financial statements contain detailed information about the specific items in these statements. Mary Buffett and David Clark walk you through exactly how to use these financial statements to apply the Buffett analysis. Where to find earnings per share. Where to calculate return on equity. Where to find the information about debt. Where to look for capital expenditure data. Where to assess gross profit margins. With this guidance, even an investor with no formal financial training can learn to do the basic analysis that the Buffett approach requires. Of course, There is also a great deal of more detailed and nuanced analysis that comes with experience. But the fundamental framework is accessible to anyone who is willing to put in the time to learn it. And the time invested in that learning is one of the most valuable investments you can make in your financial future. Because once you understand how to evaluate businesses using Buffett principles, you will never look at a stock the same way again. You will stop seeing stocks as mere price symbols that go up and down. You will start seeing them as what they really are: partial ownership, stakes in real businesses with real economics, real competitive positions, and real long-term potential. And with that perspective, the noise of the market becomes just that: noise. And the signal, the long-term earnings power of great businesses, becomes clear. Let us now discuss a concept that ties together everything we have covered. It is the concept of what Buffett calls a business perspective approach to investing, as opposed to a market perspective approach. Most investors take a market perspective. They think about stocks as market instruments. They think about whether the market is going up or down, whether investor sentiment is positive or negative, whether economic indicators are favorable or unfavorable. And they make their investment decisions based on these market-level considerations. The business perspective investor, by contrast, ignores the market as much as possible. They think about businesses. They think about whether a particular business has a durable competitive advantage, whether its earnings are growing, whether its management is excellent. They make their investment decisions based on these business-level considerations, and they use the market only as a mechanism for buying and selling, not as a guide for what to think or how to value businesses. This distinction sounds simple, but it is actually quite profound, because it means the business perspective investor is not driven by fear and greed in the way that market perspective investors tend to be. When the market falls, the market perspective investor feels fear. Their portfolio has declined in value. They may sell to stop the pain. The business perspective investor, by contrast, asks a simple question: has the underlying business changed? Is the competitive advantage still intact? Is management still doing a good job? Are earnings still on track to grow? If the answer to all of these questions is yes, then the business perspective investor is not worried. The market price has fallen, but the value of the business has not. And a lower price for an unchanged business is simply an opportunity to buy more of something they already understand and value. This is what Buffett means when he says that in the short term, the stock market is a voting machine, but in the long term, it is a weighing machine. In the short term, stocks are priced based on the popularity, the sentiment, the collective mood of the market. But in the long term, they are priced based on the actual, fundamental weight of the earnings they generate. And the business perspective investor is always focused on that long-term weighing rather than the short-term voting. Now, to conclude, let us bring everything together and look at the complete picture of what the Buffett approach really is at its core. At its heart, the Buffett approach is about identifying certainty in a world of uncertainty. Most of the stock market is deeply uncertain. The short-term price movements of most stocks are essentially unpredictable. The future earnings of most businesses are highly uncertain. The future competitive dynamics of most industries are impossible to know in advance. But a small subset of businesses with truly durable competitive advantages, offer something much closer to certainty. Their earnings history is consistent and growing. Their competitive position is strong and self-reinforcing. Their management is excellent and shareholder-focused. Their capital structure is clean and debt-free. And while nothing in investing is ever completely certain, the earnings trajectory of these great businesses is about as close to predictable as anything in the financial world. And when you can identify something that is reasonably predictable in an environment of general uncertainty, you have a genuine edge. You can make investment decisions with confidence. You can hold positions with conviction. You can resist the market's short-term noise, and you can let compounding do its extraordinary work over many years. This is the gift that the Buffett approach offers. Not certainty, because certainty is not available in investing, but clarity. Clarity about what kind of businesses to look for. Clarity about what financial characteristics indicate a durable competitive advantage. Clarity about what price you should be willing to pay. Clarity about how to evaluate management. Clarity about when to buy and when to wait. And clarity about how to hold with conviction through the inevitable short-term turbulence that all markets experience. For the investor who embraces this clarity, who takes the time to truly understand the principles and to apply them with patience and discipline, the results over decades can be extraordinary. Not because the principles are complicated, but because they are timeless. They work in any market, in any country, in any economic environment. Because they are rooted not in the temporary fashions of the market, but in the fundamental reality of how great businesses create wealth over time. Warren Buffett understood this in his 20s and built his career around it. And the principles that Mary Buffett and David Clark have so carefully documented and explained are as relevant today as they were when Buffett first discovered them. Perhaps more so. Because in a world of information overload, of constant market noise, of social media-driven investment fads, of algorithmic trading, and of instant access to prices and news from around the world, the investor who can quiet all of that noise and focus on the fundamental, long-term economics of great businesses has a genuine and lasting advantage. That is what the Buffett approach offers. Not just a set of rules to follow, but a way of seeing, a way of cutting through the noise to find the signal, a way of recognizing genuine value in a sea of uncertainty, and a way of building lasting, compounding wealth by simply doing what the greatest investor in history has always done: finding great businesses, paying fair prices, holding for the long term, and letting time and compounding do the rest. There is no shortcut. There is no magic formula. There is no secret known only to a privileged few. There is only clear thinking, careful analysis, patient waiting, and disciplined holding. Those qualities are available to any investor in the world who chooses to develop them. And for those who do, the rewards, measured not in months, but in decades, can be truly life-changing. The journey starts with understanding the principles. And that understanding is what the work of Mary Buffett and David Clark gives you. A deep, clear, practical understanding of how the greatest investor in history thinks about businesses, about value, and about the patient, disciplined pursuit of compounding wealth. Take these principles, study them, apply them with patience and conviction, and you will be on the path that Warren Buffett has walked for nearly a century. A path that, for those who stay on it long enough, leads to genuine financial freedom.